Topic number 5, audit evaluation and reviews. Audit evaluation and reviews. Audit evaluation and what here? Reviews. So in this particular topic called audit evaluation and reviews, what are the main things that you're supposed to know? And I would want you to write down the main things which you are required to know before I put on my camera. I would want you to put down the main things that you are required here to understand under topic number 5. Under topic number 5, what are the key major things you are required here to understand? Number 1, we have the concept of what here? The audit assertions. The audit what here? Audit assertions. We must be very good in the audit assertions. Those things of ACCA cover. We really have to evaluate them so seriously for us to be able to come up with an appropriate opinion. Appropriate audit opinion. Great. What else do we need, ladies and gentlemen? Under this particular topic here, we also need to be very good at what we call subsequent events. Subsequent events. We must be very good at subsequent events. Subsequent events. Is there anybody who knows what subsequent events mean? Even before I teach you, guys must be knowing subsequent means coming after. Subsequent means coming after. We have to be very good in terms of going concern. Going concern never misses in your exam. The going concern assumption. Then we have this 5.4. We know that related parties have really taken down many organizations, related parties. Who are related parties to a company? For example, when I want to audit company ABC, I have to look at the various related parties. For example, does it have a subsidiary? Does it have an associate? Does it have a joint venture, right? Who are the key management staff? Those are related parties. Do they have, for example, a pension scheme? If they have a pension scheme, that is a serious related party because most directors have really used these pension schemes under other. For example, you get some organizations running circles within their firms. Those are avenues of fraud. Those are related parties we need to be monitoring very keenly, like what we are told with these related parties. For example, the key management staff. Every year, key management staff, the directors, if the directors of Safaricom have to realize them, have to disclose them, and the related parties, and I'll be able to show you today how it discloses them. Tell us in this case here, how much they earned, how many meetings they came for, etc. Related party is very important. Ladies and gentlemen, I have to teach you how to draft the management letter, management representation letters. Very, very important. Then we have the group audits. Group audits rarely misses. Under group audits, you are required to understand who is a group auditor. This group auditor may not be the one who will be auditing the subsidiaries. The subsidiaries in this case here have a right, they are independent companies, they can choose whomever they think is fit to be their auditor. So we shall be having what we call a group auditor, and then we shall be having number 2, the component auditors. The component auditors, although in most cases, group auditor may end up in this case here, auditing subsidiaries. So if somebody comes and tells you, you know what, I'm auditing this subsidiary, you'll not say no. As a group auditor, what I'll be concerned with is the qualifications of the component auditor. How independent is he, right? When I ask for information from him, is he able to cooperate? So I have to teach you how to carry out group auditing. Group auditing is very important. Ladies and gentlemen, we have the analytical reviews, the ratios, assessment of the trends, etc. And then we have evidence and the testing considerations. How do we collect this evidence, etc. We have the use of work of others, like the internal audit, the experts. Of course, auditing, ladies and gentlemen, is quite a wide area. There is no way I'll be able to carry this auditing alone. There are things that I may not be having expertise of. If, for example, I would want to value a company's premises, I don't have that expertise. I may need a valuer. I'll be relying on evidence collected by who? The internal audit. So then I have to look at whether, again, they are qualified, whether they are quite independent, whether they're independent of the organization, and of course, whether they are able to put up adequate resources to be able to do a good job. Okay. Then we have what we call the company audit. Company audit is very important. And then we have lastly 5.11, the role of audit committee in the audit process. This rarely misses the concept of audit committee. So ladies and gentlemen, I would want in this case here to help ourselves here by really going very fast in this and looking at what basically we call the low-hanging fruits. The low-hanging fruits. Low-hanging fruits ni gani? Kumbuka at this level, inafaa unajua ni helicopter style. Helicopter style means you are getting the key stuff, right? Key concepts, and then know how to apply them in your exam. It's not about cramming. Cramming was in the earlier level, the intermediate level. This is an applications level. Like now when we talk of subsequent events, you're supposed to understand what they are and how do you apply them in real life situations in your audit work. Great. So please let me know whether you are able to see this young, beautiful lady here. Are you able to see some young, beautiful lady here? Mimi nataka nyinyi mnakuwa hata nyinyi mnakuwa international brands. Mnakuwa international brands. Sio lazima unaoa Mwafrika, right? Be an international person. Sio lazima uolewe na Mwafrika. Be an international person. So they're not telling me that they're able to see my screen. That is, I can see you understand my yes. Great, 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 great. Yes, great. Now, ladies and gentlemen, I would want us to tackle a few areas here. So we shall be able to look at the going concern. We shall be able to look at related parties. We shall be able to look at these written representations, subsequent events. Subsequent events are very important for me. Let's start with related parties. Related parties, page number 93. You have this book already. You have this book with yourselves. Page number 93, related parties, your relatives, related parties. Related parties wanaharibu biashara sana. Ni kama sasa ukianza biashara, halafu unaweka watu wenu peke yake ati ndio wana kwa top management. Itakuwa international disaster. Itakuwa international disaster. Utalose, kutakuwa na high staff turnover, etc in group audits. Great. Here, related parties, chapter 20. So are we ready to start? 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 Now, ladies and gentlemen, when they mention this particular terminology, related party, which also comes in your AFR theory, when they mention the words related party before I introduce, what comes to your mind? Who are related parties? Who are related parties? Who are related parties? Who are related parties? What comes to your mind? Somebody is very good in Googling. What is a related party in your own understanding or from Uncle Google? Who is a related party? I'll reshare the book, no problem. I will reshare the book. Okay. Who is a related party? Nakwambia ni high level. It's high level. I don't want to see my AAA students cramming. No. No. And then today I'll also give you a secret of passing this paper round 1. I don't want us to pass this paper round 2. No. It's round 1. We put it down. I'll give you a secret. Parties involved in a similar transaction? No. I'll not take that one, Nelly. I've never done that. This week has been crazy. has been crazy to me, but from now today up to Tuesday, yours faithfully, yours faithfully, yours faithfully. Great. I expect you guys, this related party is a person or an entity that is related to the reporting entity. A person or an entity that is related to the reporting entity, to that entity whose financial statements you are auditing. The reporting entity, the reporting entity, the reporting entity. Sija understand Lucy anasema namna gani hapa. Sija understand Lucy anasema namna gani hapa. The people who share blood relationships, I love that, but not in the context of a company. A company has got also its own relatives. Who are its relatives here? Who are the relatives of these companies? And why should we study about them? Why should we take time as auditors here to understand relatives of what here? A company, because of what here? Theft. These are the number one suspects when it comes to what here? Stealing. These are the number one suspects when it comes to crazy. Yeah, this week was a crazy one. Yeah, parties with an interest to a given entity. I love that they have got an interest to a given entity. Thank you very much. So please allow me to share now the book. We discuss what these related parties are. Now we are told here, related parties can pose real difficulties for auditors because it can be very difficult to detect the relationship and the related party transactions. It can be very hard. Certainly, the letter of representation sent by directors to the auditors at the end of the audit would make reference to the fact that either there were no related party transactions or that all have been done what here? Disclosed. Ladies and gentlemen, remember that related parties is a serious matter. And really, as an auditor, it is not my responsibility to identify related parties. No, this is the responsibility of who? Of directors. That is why the directors have to commit themselves in writing through what we call representation letters. They have to tell the auditor that these are our related parties. And this is the business that we had between what here? Related parties. So we are saying something very important, that yes, I will also be putting in some checks to discover some abnormalities in terms of what are these relatives. But it is not my major duty. It is the duty of the management of a company. It is the duty, responsibility of the directors of a company to disclose what we call related parties, and they have to put that down in writing. They give you that information in writing. Very important for us to be able to appreciate that from the word go. From the word go. Ladies and gentlemen, so we are told here that, for example, one person owns two companies, and each company has different auditors. If company A sells goods to company B at inflated prices, company B will make artificial losses, and the company A artificial what year profits. Perhaps the owner intends to put company B into liquidation to escape liabilities, but the cash has been safely transferred to company A. It would probably be difficult for the auditors to detect what was going on. Ladies and gentlemen, remember the concept of what we call transfer what year? Transfer pricing. Of course, you normally do transfer pricing in advanced management accounting. True? Do you have transfer pricing in AMA? Transfer pricing in AMA. They must have forgotten transfer pricing. Yes. So we have company A selling goods to company B. If they are related, these companies here will always want to play games around. So there are things in this case here that they will do what here, that they will inflate, right? Their prices. So that if company B is buying these goods, automatically, because it's a cost to company B, their profit will go down. Remember, we normally use transfer pricing here to shift profits between what here jurisdictions, different jurisdictions. If, for example, ladies and gentlemen, we happen to be having like a subsidiary in one of these tax havens. For example, we have a subsidiary in one of these tax havens. Is there somebody who knows the concept of tax havens? Could you kindly give me examples of tax havens? This came some time back in taxation. Countries that are tax havens. Is there somebody who can remind us? They're saying Netherlands, Cayman Islands. Rogers, look at the spelling of the word Cayman. Cayman Islands. Mauritius. Mauritius. It's good you happen to know about these tax havens, because I would want you, ladies and gentlemen, once you become so rich, you must get away of also taking some of your monies where they are. Russia, they're saying Russia is is a tax haven. So we would want to shift most of our profits to tax havens because of the tax advantages like that, which are there. But you see, again, ladies and gentlemen, as we do that, that shifting of profits between related entities can really confuse the stakeholders. The stakeholders who at the end of the day will get into big losses. We could have a situation like this. People are trying to explain to us two companies owned by one individual. And this individual perhaps is crafty. He wants, in this case, here to run away with people's assets. He will do that kind of a transfer of profits. And then I have this company A, for example, which is in Kenya, being wound up, right? So it will be very important for us to put in place mechanisms of identifying these related parties, because people have used related parties for so long to swindle various stakeholders. So what is a related party and why are they difficult for auditors? Related parties are defined in IAS 24. I told you this is something very important for those of you who are doing advanced financial reporting. Today they'll get another understanding of this related party. The objective of IAS 24 is to ensure that an entity's financial statements contain disclosures. Financial statements contain disclosures necessary to draw attention to the possibility that its financial position and the profit or loss may have been affected by existence of related parties and by transactions and outstanding balances, including commitments with such parties. A related party, like somebody called Mary told us, a related party is a person or an entity that is related to the reporting entity. A person or a close member of that person's family is related to a reporting entity if that person has control, joint control, or significant influence over the entity, or is a member of its key management personnel. An entity is related to a reporting entity if, among other circumstances, it is a parent company, it is a subsidiary, it's a fellow subsidiary, associate, or a joint venture of the reporting entity, or it is controlled, jointly controlled, or significantly influenced, or managed by a person who is a related party. Note that subsidiaries, associated companies, joint venture partners, and the entity's pension schemes, people forget this. The entity's pension scheme are related parties. Subsidiaries, associated companies, joint venture partners, and the entity's pension scheme are related parties. You might think it is easy, for example, to identify when a company is an associate. And this would be expected when producing the group financial accounts. But if you are auditing the associate, how would you detect if it was trading with another company that was also an associate of the same parent and therefore under the influence of the parent? Detecting ownership by family members is also very difficult. This might not have all the same family name. Particular problems arise. Listen, particular problems can arise if the transactions between the related parties take place without charge. You are being given things for free. For example, simply moving inventory from one party to the other without any accounting entries will distort profits. Number two, related party transactions are buried amongst normal transactions without you disclosing. There are parties that the auditor is unaware of, complex group structures can make identifying related parties very difficult. Management might try to conceal the relationships, especially when these directors are giving themselves like company vehicles, right? Somebody assigns their wives, in this case here, assets belonging to who? Assets belonging to a company. They would not want to disclose husband-wife relationship. Management simply might not know that certain transactions fall within related party rules. There is nothing illegal about a company trading with a related party. That is very normal. This happens all the time in groups. However, as described above, the existence of a related party transaction increases the chance that transactions are not normal, they are not at arm's length, or have been entered into to defraud other parties or to evade what here? Tax. Responsibilities. It is the management's responsibility to identify and disclose related party transactions. However, of course, this does not absolve the auditors from exercising professional skepticism or from trying to obtain evidence about the existence of related party transactions. If related party transactions are not identified by management or the auditors, there is an increased risk. There is an increased risk of, number one, fraud, unfair presentation, and then non-compliance with the law, especially tax legislation. Now we shall look at the audit procedures in a while, but I would want us to take like 3 minutes and think through what related parties are. What related parties are? What are related parties? How do you understand these now in your own language? If you're told here in your own language now, you're not Googling, in your own language. If you're asked here to define the term related party is in your own language, what will you tell us are related parties? Sorry for disturbing you a little bit here and there. It's normal. In your own language. The other day, somebody called me, told me, Mwalimu, what? My papers have been withheld by CASNEP because of this and this and this, right? At times, even cramming can cost you. Don't cram too much. No, you're a scholar. Know how to represent these things in your own language. They're not talking to me. They're not talking to me. Remember, when you are defining this, I would always rather those students who even go ahead to give us what here examples of these related parties. Examples of these related parties. They're not talking to me. I do not know why. Okay. 2 or more parties that have a common interest. I'm still waiting for better definitions. I would rather in this case here has an interest in an entity that gives it significant influence over the entity's related party. Parties that influence decisions of other organizations, company, parties with significant influence in a company. If I were you, I would have said, then parties here with a significant influence or which controls, right, this company. It is the entity that is rated with the reporting. It is the entity that is rated with the reporting entity. Any entity or person, that is related with the reporting entity automatically becomes who? Becomes a rated party. Any entity stroke person that is related to the reporting entity becomes a related party. For example, parties that significantly influence. For example, the parent company of this subsidiary, its own subsidiaries, associates, pension schemes. Those are what here? Related parties, key management personnel, their family members. If, for example, I'm a director at RCM, then my wife automatically is a related party to RCM College. My kids are related parties. If, for example, RCM Online College does business with them, then it has to do what it has to disclose in the financial statements that RCM Online College did this kind of business with Madam so-and-so, who happens to be the wife of this and this director. You have to disclose that RCM Online College did business with, for example, this entity that is a parent, did business with, for example, this entity, which is what here and so. It's all about disclosure. It's all about disclosure. Great. Joint ventures, yes, I love that. I love that. Great. Now, ladies and gentlemen, then what will be the audit procedures that you will, ladies and gentlemen, what will be some of the audit procedures that you will be able to put down as an auditor when you are auditing this fragile thing called related parties? What are some of the audit procedures? Some of the audit procedures that you'll have to put down, that you will have to undertake to ensure that you really do justice to the auditing of related party transactions. Can we use IAEOU? Of course, IAEOU will also really help you quite a lot, yes, but don't really be stuck with those ones alone. Remember, audit procedures, mingi hata ku review. I'll review. Mingi ni hivyo. Inquiries. No. Audit planning is not a procedure. Audit procedures. Identification of what? Do you call them into a parade? Alex. Very good. Vivian Sani amesema ya kwanza ya review of previous auditing working papers. Because remember, we said that related parties, normally the management must identify them and send them to the auditor. So they must be somewhere. I'll start by reviewing. Risk identification, apana. The first thing I would want to do is to really analyze and see whether we have these auditing, or rather we have these related parties, and whether they have been genuinely given to us by who? By the management. Victor unajua sana. Written representations from management. Ukiuliza audit process, hiyo inafanga hata ikuwa ya kwanza. Hiyo ni inquiry from management. Unaandikia barua, unaambia you want to know whether they are related parties. So written representation from management, andika namna hiyo. Aha. Kuna interviews, Diana anasema interviews, but you see interviews at the end of the day, they have to end up with what? A written representation from management. Tell them to commit themselves, regardless of what they tell you. Remember, we don't really believe in oral evidence. Circularization, like you circularize, you talk to various people to see whether mnajaribu asante, mnajaribu, lakini tuendelee. Nipate hizo points. The audit procedures. I cannot see anybody saying that I will strive to obtain the shares register. I would want to know who owns this company. The shares register is very important in identifying related water parties. Yes, like reviewing a correspondence with legal representatives. That is very, very important. Yes. Legal representatives, yes. Any correspondence, yes. Of course, you'll at times get even people having taken each other to court, right? So when you take the lawyer's files, reviewing minutes, yes, that's very important. I'll take that. The board minutes, yes. The board minutes, I can easily get into. Thank you very much. Review the entity's income tax returns. Income tax returns, that can really assist me, yes. I can get to know a few things here and there. You guys are bright. We are almost there. We are almost there. We're almost there. We are almost there. We are almost there. Reviewing the internal control systems. Let's go through them very fast. Let's go through them very fast. They are here. They are here. So audit procedures. Number one, inquire from management about related party transactions. Auditors would have to explain the concepts and they give examples to help management. Inquire. Review last year's working papers. Review board minutes. Review the accounting records for unusual transactions. This automatically is the analytical what here? Analytical procedures. Review the accounting records for unusual what here? Transactions. Review bank certificates. One company might have given guarantees on behalf of another, yes. So review bank certificates. Review principal shareholders of companies with whom the client trades. Ask the directors about their other directors and share ownership. Review correspondence with lawyers. This is something that's very important. Review investment activities, e.g. the purchase of shares that might indicate that significant controls has been acquired. Inquire into the names of pension trustees. Obtain written representation from management. Obtain written representation from what here? From management. From management. Ladies and gentlemen, again, to disturb you a little bit, amongst all these points, which point ya kusema ukweli kabisa hauwezi ukasahau? Audit procedures on related parties. Which procedure hauwezi ukasahau hata siku moja? Hata siku moja. Which procedure hauwezi ukasahau? Which procedure hauwezi ukasahau? Iseme Evelyn, niweze kustick kwa mind. Iseme. Which procedure ambao hauwezi ukasahau? Lawyers. Reviewing of board meeting minutes. Board meeting review. I love that. Working papers last year. Working papers. Checking for any bank, possibility of bank guarantees, the bank certificates. Obtaining written representation from management. Hiyo imenitosha. Written representation from management, hiyo imenitosha. Hata staki ingine tena. Staki ingine tena. Na maybe ile concept ya principal shareholders from the shares registry. From the shares registry, it's important you get to know really who owns this company. Now, ladies and gentlemen, I would want you to do me a favor. I want you to go to the ACCA question and answers booklet that I gave you last time. Do you still have it? The question and answer booklet that I gave you last time, do you still have it? Do you still have it? The ACCA, I would want to give you a secret. Please go to where they are giving you, let me try to open mine very fast. Let me try to open mine very fast. There is a trick I want to show you. Once you know this trick, you can never get a fail in this paper. There is one that I gave you. Let me just check here. Okay. Hebu share kitabu kwa WhatsApp tena. Share kitabu kwa WhatsApp tena tuone. Please share kitabu kwa WhatsApp tuweze kuona. Hebu share kitabu mko nao tuone gani. Hebu share. Share kitabu ya AAA. Ya question and answer. Yes. Great. Hii kitabu ukiwa nataka ni kuonyesha, ukijua kuitumia, you will never get a fail kwa hii paper. Utapenda hii paper kwa paper zote sana. Haya. Haya. So let me open it. Then I show you something very important. Haya, abracadabra. Mwalimu ndio yuko hapa. Please tell me whether you are able to see our mother. Are you able to see the face of our mother here? Yes. Thank you very much. Great. Now this book, what you do, you go right away up to here. Hii ndio mama ya kila kitu hapa. Hii ya topic index. Unapo hii topic index. Kwa topic index, unaangalia kama section yenu mko na mambo sana ya tendering. Imekupatia the questions ambazo zina capture mambo ya tendering. Right? So unaangalia pole pole uone kama hii umesoma sasa hivi, kama iko na pahali popote kama group audit is very important here. Like the entire chapter hii tumesoma inaitwa evaluation and review. It has got so many questions here. I'm trying to look for a related party. Ukiona haiko hapa, iko kwa ile ya lower. Iko kwa ile ya lower, kidogo dakika moja. Pana choka, nataka nipatie shortcut ya kupita kitu haraka haraka. Atafutae achoki, akichoka kesha pata. So hivi vitabu lazima uzitumie interchangeably. AA and AAA za ACCA, very important. Na maswali yenu yanatoka tu hapo tu. Na pia usifanye maswali yote, hapana. Unaenda na hiyo index, topic index. Dakika moja tu kidogo tu. Like Rogers amesha identify moja question 18. Rogers ame-identify moja question 18. Because I would want us to get them in an easy way. Now, like if you look at question 18A, discuss why the identification of related parties and the material related party transactions can be difficult for auditors. Bonge hapo tusikie dakika moja wewe. Utasema nini hapo sasa? Utasema nini hapo? Discuss why the identification of related parties and the material related party transactions can be difficult for auditors. Utasema nini? Pata potea. Lack of documents to support related party transactions. I love that. Management will want to conceal this by all means. I love that. Alafu kitabu sasa iko na answers nyuma, Unaona nyuma yake. Iko na answers hapa nyuma yake. Ukienda tu hapo 18 tena kwa answer. 18 tena kwa answer, unasoma haraka unatoka kwa hiyo chapter. M36. Okay, great. So they are right here. Remember, it's 5 marks. So 5 marks, you have to really sweat it out. First of all, you come to, they'll give you short answers here. So problems in identifying related party transactions. Number 1, complex stroke subject definition of a related party. Reluctance of management to disclose. Hard to identify from the accounting system. Deliberate concealment for fraud, what we call window dressing. Materiality, relatively complex to apply. So kisha soma hiyo fupi, so nakuja unasoma vile explain or expound. Related parties. Related parties are defined by AS 24, related party transactions and party disclosures, and can be complex subject and difficult to identify. It's not always immediately obvious to management or the auditor whether a party is really related. For example, IS-24 states that a party is related to an entity when the party controls, is controlled by, or is under common control with the entity. Control may not always be easy to identify within a complex multinational group, or if the controlling party is a trust, it may be difficult to prove who, if anyone, controls it. There is frequently little or no documentary evidence of related parties, and so the auditor often has to rely on management written representations for their disclosure. If management wishes to hide a related party, it may prove difficult for the auditor to identify it through normal audit procedures. Related party transactions, management systems are not designed to distinguish related parties or produce a summary of their transactions. Management will generally have to carry out additional work to identify and collect related party information. If this work is not completed, it may prove difficult for the auditor to detect all related party transactions. Management may conceal a related party transaction in full or in part. This could be because they are motivated by more than ordinary business considerations, for example, to enhance the presentation of the financial statements as part of fraud or window dressing. If management conceals a related party transaction, it will be very difficult for the auditor to identify. Related party transactions may be material in substance rather than size, so difficult to detect using ordinary audit procedures. It may also be difficult for the auditor to determine whether transactions are material or related to related parties who are individuals such as directors and their what here, their families. Great. Ladies and gentlemen, no, I'm not tired at all. I'm not tired at all. I'm not tired at all. I'm very much okay. Now, I can see what Rogers is telling us there. Rogers is telling us that there is a question from the past paper, CPA May 2021, question number 1. So I expect ourselves, ladies and gentlemen, to look at this question and post answers on WhatsApp. So then, ladies and gentlemen, this one is a homework, which I expect my students here to do. CPA May 2021, question number 1. Now, listen and listen to me very well. I would want us in this case here to go and look at, so then what are we required after you've identified these related parties? What are we supposed to go and do what? Disclose. What are we supposed to disclose? Okay, just 1 minute. Great. So here we are. Tunasoma subject ya maana sana hapa leo. Hapana sema unataka kupotea. Hapana tumie lugha kabisa. So here we are. Ladies and gentlemen, ukiangalia vizuri hapa, tunaambiwa disclosure requirements in the financial statements regarding these related parties. Now listen, disclosure requirements in the financial statements. Relationship between parents and subsidiaries, irrespective of whether they have been transactions between the parties. Even if there are no transactions between those parties, parents and subsidiaries must always be disclosed. Compensation to key management personnel, including short-term, post-employment, and termination benefits and share-based payments. Zile mnasoma kwa AFR, hiyo lazima always ionyeshe. They have to disclose in the financial statements. Minimum disclosures for related party transactions include the amount of the transactions. So parent subsidiary, you must give us that internal sale. The amount of outstanding balances and their terms. So if there are any inter-owings, you must give us the amounts there and give us their terms. When do we expect this amount here to be paid? The allowances for doubtful debts relating to outstanding balances. if there are any doubtful debts that you need to expense, first of all, you must give us their outstanding balances. And then, of course, the amount you expense here, recognized in the period in respect of a recoverable or doubtful debts from related parties must always be given. Listen here, look at these minimum disclosures, the amount of the transactions, the amount of outstanding balances under their terms, any doubtful debts. Well, once we really think that this is doubtful, then these has to be disclosed. And of course, at the end of the day, if it's doubtful, some part of it could be expensed. You have to disclose that. Examples of transactions with related parties include purchase, stroke sale of goods, other assets or services. If we are leasing some properties to our subsidiaries, that has to be disclosed. Loans and other finance arrangements, providing guarantees or collateral. All right, that is very, very important. Those must be shown. And now, ladies and gentlemen, unless there is a question, that is all that I had for you for today regarding related parties. Regarding related parties, and if you allow Mwalimu shall be able to take on something. I'll take on 3 things today. Leo sina haraka, wacha nimechoka, nataka kwenda wapi? Hakuna, lazima tusukume chapter tumalize. Right? So related parties, you at least imesonga mbele. Right? Now, if you looked at our chapter, they really want us to talk about going concern. I read for you the things that these people want us to talk about. So going concern is one of them. If you have this book, I would want us to go to page number 115. Page number 115. Yes, I'll share. Hii lazima page number 115. Kwa nataka uongee kuhusu going concern. That's very important. 115. Page number 115. Kwa nataka tuongee kuhusu going concern. So tutarudi kwa hapo, lakini tuongea kwanza kuhusu going concern. Remember, as an auditor, ladies and gentlemen, when you give an opinion, then automatically you are telling the public what? That this company shall be there for at least how many months? For at least 12 months. Listen, let me put on my... When you give an opinion, ladies and gentlemen, you are communicating something very important. When you give an opinion, how comes this camera is not able to see me? This camera is not able to capture Mwalimu today. As an auditor, you've gone ahead and you say, ladies and gentlemen, that you are giving an unqualified opinion. So when you give an unqualified opinion, of course, it means that you have expressed. Just a minute, I have to fix my camera. So as I change my batteries here, as an auditor, when you give an qualified opinion, you've said that the books of accounts of RCM portray a true and a fair view. No problem. It means that you are also giving some kind of a guarantee that this organization will be there in the future, where your future, yes. So you're saying that we have given RCM Online College a qualified opinion. So basically we are telling these stakeholders that RCM Online College, books of accounts are okay. The financial statements are okay. And again, at the back of that, this company's going concern is okay. It's not under threat. It shall be there At least for how many months? You are giving them a guarantee, kind of a guarantee that it shall be there for a period which is more than what year, 12 months in the future. Remember the case of PwC versus Uchumi. PwC gave an qualified opinion to Uchumi. What happened down the line? 3 months down the line, the company went under. All right. So of course, you guys are quite aware of what happened. The auditing firm was taken to court. But as you are aware, most of our judges do not have, especially the accounting concepts at their fingertips. Anytime, any case, just go to our commercial courts. You'll see how these people struggle with debit and credits. And that is why, if, for example, you go to the US, the judges over there are CPAs, because most of the legal matters are what? They're financial in nature. They're accounting in nature, businesses going under, etc. So, of course, PwC won the case. But at the end of the day, if you listen to it very well, it was just an issue to do with what are the judges. Because as an auditor, when you give an opinion, you're also telling us at the end of the day that this organization, a good opinion that is, you're telling us at the end of the day that this organization will be there for at least how many months? 12 months. Remember also that it is not your responsibility to check on these going concern issues. It is the responsibility of management. It is management through a representation who have to tell you that, you know what, this company has got no issues. So my role as an auditor is to audit what they tell me. My role as an auditor is to put in procedures that will be able to enable me gather sufficient, appropriate audit evidence to be able to support my argument regarding what here going concern, regarding going concern. Now listen, this is just a 5 minutes thing. This is a 5 minutes thing. Here taina maneno mengi, going concern. Wanasema going concern, if a material uncertainty exists, which is adequately disclosed in the financial statements, the auditor is required to draw the attention to the related disclosure in a separate section of the auditor's reported headed what year material uncertainty rating to going concern. I know you guys are able to remember this thing. For example, what we call the key account matters, the key audit matters. Then you have got material uncertainty relating to going concern. So for example, we draw attention to note number 6 in the financial statements, which indicates that the company incurred a net loss of ZZZ during the year ended December 31st, 20X1. And as of that date, the company's current liabilities exceeded its total assets by YYY. As stated in note number 6, these events or conditions, along with other matters as set forth in note number 6, indicate that a material uncertainty exists that may cast significant doubt on the company's ability to continue as a going concern. Our opinion is not modified in respect of this matter. I'm repeating again that if a material uncertainty exists, which has adequately been disclosed in the financial statements by the management, then the auditor is basically required to draw attention to this matter by doing an appropriate disclosure in a separate paragraph called MURGC, Material Uncertainty Rating to Going Concern. Generally, if the directors or the auditors think the company might not survive into the foreseeable future, there is a going concern problem. Foreseeable future is not defined, but under IFRS, it should not be less than 12 months from the end of the accounting period. They're talking about UK GAAP, which specifies that it should not be less than 12 months from the date of approval of the financial statements. Remember, it is for management to make an assessment of an entity's ability to continue as a going concern. The auditor's responsibility are to obtain sufficient, appropriate audit evidence, conclude and report. If the notes do not disclose the going concern uncertainty, the auditor must express a modified opinion because of inadequate disclosure means that there is an element of the financial statements that is not presented fairly. If there is no realistic possibility of the company surviving, the financial statements should be drawn up on a break-up basis. And if not, the audit opinion will most likely be what here? Adverse. Now, ladies and gentlemen, I would want you to listen and listen to me very, very carefully. If the management has been able to assess their going concern issue and realized, hey, we are not going to be there in the next 2-3 months. We are not able to honor our obligations. Our creditors are taking us to court. We shall not be there. So if the managers are able to assess their going concern status, they have found this going concern status of theirs to be wanting, and then they acknowledge that in the statement, or rather in the financial statements, in the notes, they acknowledge they've got a going concern issue. That's number one, they've acknowledged. And then the financial statements themselves have been prepared on what we call break-up basis. Break-up, B-R-E-A-K, breaking up. You're going to break up. So two things. Number one, they have recognized there is a going concern issue. Right? And then number two, ladies and gentlemen, they have prepared their financial statements like they're going to blow up. They're going to break up. If that happens, as an auditor, I'm going to issue unmodified. I'm going to issue unqualified audit opinion. However, I must introduce what we call a new paragraph called material uncertainty regarding what you're going concern. And draw the attention now of the stakeholders. Tell them up there in the notes, the accounts, like we were told, note number 6, the directors are owning up that they have a going concern what here? Challenge. That they are creditors who have taken them to court and they are seeing the possibility, the probability of the case being ruled against the company being what here? Very, very high. Very high. So listen, I would want to repeat this because it's very popular in your past papers. Number one, for me to issue an modified and qualified audit opinion regarding going concern, two things. The management must recognize, must disclose the going concern challenge in the notes of the accounts. Number one. Number two, the financial statements must be prepared on a breakup basis. Breakup basis means what here? You recognizing like all your assets at fair value, at market value. Like if you were to sell these things today, right? How much will we recognize? That is the value you shall be taking your assets at, and every other thing. It's called a break-up basis. If that happens, ladies and gentlemen, then no worries. But now, what if we have a disagreement? The management have done their responsibility. They've assessed the going concern of their entity. Of course, they may have seen issues here and there, but they don't want to disclose that in the financial statements. And as an auditor, when I look around, I can see thick. It's thick ahead, thickness ahead. These guys will not make it. So what I'll do, I'll first of all discuss this with management. Tell the management that, you know what, I'm going to qualify my financial statements. And depending on the magnitude of this uncertainty, if the uncertainty that is hovering around the company is quite material and pervasive, and the management doesn't want to recognize that, then I'll go ahead and issue what we call an adverse what? Adverse opinion. I'll go ahead and issue an adverse opinion, right? So it'll be very important for me to recognize those things. Now, ladies and gentlemen, listen and listen to me very well. Listen and listen to me very well. Listen and listen to me very well. We're learning something very important here, very practical here. So indicators of going concern uncertainty as an auditor, this is very important for me. Signs that the company may have going concern difficulties include the following. negative operating cash flows. And that is why when you get your cash flow statement, don't look at the investing alone, right? Don't look at the financing alone. Go to the operations. Is this company able to generate enough operating cash flows? Number two, inability to pay suppliers when due. And auditors are quite sensitive to this because they're also a supplier. They are also a supplier. Remember, at the end of the day, even themselves here, they will not be paid. Operating losses, yes. If the borrowing facilities are coming to an end and the new ones haven't been agreed. Loss of key staff or key customers can mean that the company is unable to trade or unable to sell. Technology changes can render the company's purpose and main product redundant. Legislative changes, angalia kama hizi maduka za scrap metal, right? Non-compliance, especially with the tax, KRA itakuja itakupatia shida sana. Audit work, ongoing concern, uncertainty. So as an auditor, what will I do, ladies and gentlemen, on matters going concern? Number one is to evaluate the management's plans for future actions in relation to its going concern and whether the outcome of these plans are feasible and likely to improve the situation. Management watakudanganya sana. Watakwambia unajua sasa tunapanga hivi mwezi wa 9 tutafanya. So my role will be to evaluate all those assumptions and really see how practical are they. If, for example, this is a subsidiary of a parent company and the parent company is making promises, I'll tell the parent company to give me a comfort letter. It's called a comfort letter. Let us really be very comfortable that this thing will be there by you, giving us an assurance, but that by this particular time, you'll be able to, for example, organize a loan for them. Where the entity has prepared a cash flow forecast, because they'll try to cheat you also on this. They try to prepare cash flow forecasts. So evaluate the reliability of the underlying data, which has been used to prepare the forecast. Determine whether there is adequate support for the assumptions underlying what. So here I'm testing two things, the data itself and the assumptions. Considering whether any additional facts or information has become available since the date on which management made its assessment. Management may have made the assessment, say 2 months ago. So I'll have to sit down and really look at what has happened between that time and now. Requesting written representations from management and whether where appropriate, those charged with governance regarding their plans for future actions and the feasibility of what year these plans. So audit work, ongoing concern, and certainly, ladies and gentlemen, there is quite a lot you have to do. These guys have given us just very few things. Very few things. If I want to assess going concern, I know this is the general responsibility of who? Management. So I'll be going through, for example, board minutes. I'll have to look at correspondences between the company and, or rather even the legal department. I have in this case here to look at the lawyers' files regarding what here this company as well. I have to do a lot of analytical procedures. Take financial statements of this company for the last 5 years, compute appropriate ratios, right? Because where going concern issues are, there'll always be a lot of what here creative accounting. There shall always be what we call window dressing. So all that I'll have to really consider. Great. Now, could you kindly go to that P7 paper and now look for a question on going concern? Look for a question on going concern before I tell you what we shall do next. Look for a question on going concern before I tell you what we shall do next. Go to that paper of ours. Go to that paper of ours. Students are not going to that paper. Students are not going to that paper. P7, they are not going to P7. They are not going to P7. They are not going to P7. So P7, like that. You can even use control find. Great. So going concern. Always when you finish a subtopic, go and look for going concern. For that subtopic, must be somewhere. Going concern. There's a place they list those things very nicely. I think I'm the one who's not getting them. Going concern. So you look at ACCA, question 22, question 22. You look at ACCA and then you go to CPA past paper. ACCA do like 2 questions and then you go to CPA past paper, looking for what here they're going concern issues. And for ACCA, don't go for the short questions. No, always not after a longer question, the case study question, ndio zenu za. So like question 22, Juliet, auditors should accept some of the blame when a company on which they have expressed and modified audit opinion subsequently fails. And they should also do more to highlight going concern problems being faced by a company. Required, discuss this statement. How many marks are they giving you? 8 marks. Yes, you kidogo. Yes, you kidogo. 8 marks. Wanafunzi wengi wa CPA hapo wataandika point 2. Alafu nakupigia simu nakwambia mwalimu tumenyorosha. Ikija inakuja upside down. Inakuja upside down. So I want us to reflect on that for a few minutes before we look at the answer. Alafu nataka sasa mwanze kuwa very vocal katika WhatsApp, giving us questions on the past papers AAA and trying to give us their answers. We must be very vocal. Sasa mahali tumefika. Great. So question number 22 in the answers. Question number 22 in the answers. And most of your questions are here. The ones which are in your past papers, most of them are here in ACCA. A good student should be able to locate them very fast and remember this question was tested here. Okay, apricot, Juliet, it's here. So Juliet, they are giving you top tips. The first part of this question was difficult, and doubtless many candidates will struggle to make up 8 marks here. It's important to discuss questions that you plan your answer before you write it. If you don't plan, there is a danger that you'll change your mind about what you want to say while you're already writing. This will only waste time and will be unlikely to score marks. You need to plan your answer and divide your discussion into clearly structured paragraphs. Within each paragraph, you should aim to have an introduction, a point, and a conclusion. So they've given us discussion points here: management responsibility for risk assessment. Auditor should be aware of going concern issues. Auditor must not take on management role. Misunderstanding of roles of management and auditor. Auditor may be to blame if overlooked a fraud, stroke other matter. Financial statements contain disclosure on risk assessment. Users may not be financially literate. Auditors could make problems more visible and understandable. So nakuja unasoma answer na ndasoma mbio jameni. The concept of an expectations gap between auditors and the public is a key lens through which assertions such as this one can be viewed. The first part of the statement would appear to assert that the auditor is in some way responsible for the failure of a company. This is not the case. Those charged with governance are responsible for risk assessment and risk management. It is not the role of the auditor to become involved with the entity's risk management processes. Indeed, this could be deemed to constitute a management role, which would compromise the auditor's independence. However, it is true that the auditor should gain understanding of the client's business. This is a crucial requirement of the ethos. Amongst other things, It is necessary for an auditor to audit management's assessment of the appropriateness of the going concern assumption, for which a good understanding of the business risks faced by the client is necessary. The auditor must judge whether the going concern assumption used is appropriate. However, this is never a matter of cut and dried logic. It's a judgment based on assessment of risk. It is the nature of risk for there to be uncertainties, and it is the nature of judgment to contain elements of doubt. It is therefore to be expected that there will be cases where the auditors judge the going concern assumption to be appropriate, and yet the company falls within the year. The question is not whether the assumption was proved correct by subsequent events, but whether the auditor's assessment was reasonable and in line with auditing standards. There is more scope for discussion on the question of whether auditors should do more to highlight problems. This may be the responsibility of management. It will be possible for regulators and setters of accounting standards to require increased disclosure on going concern. For example, financial statements could be required to provide more narrative detail regarding the risks faced by an entity. At present, auditors should disclose the presence of material uncertainties of a going concern by way of an emphasis of matter paragraph in the auditor's report. And if they deem the assumption to be inappropriate, then the opinion would be modified. It may be possible for these disclosures to be made clearer than they are, or for auditors to use their report to draw users' attention to any parts of the financial statements that are significant to the assessment of going concern. In conclusion, it's unfair to require auditors to accept the blame for companies' failure, which are the proper responsibility of management, although it may be argued that more could be done by auditors to highlight going concern problems where they exist. Out of the 8 marks ungepata ngapi ukiangalia? Out of the 8 marks ungepata ngapi ukiangalia swali? Sema ukweli kabisa, out of the 8 marks ungepata ngapi? Out of the 8 marks ungepata ngapi? 5. Great, that's bold. 5. 3, Patricia. 4. Iko mwenye amefunga macho Ana amesema kusema ukweli kabisa 2. Thank you very much. Now, ladies and gentlemen, if you allow me, I can see some of us dropping from the call, from the meeting, but really, I would want to discuss the last thing for tonight. I still have time. I'm well within time. Nyinyi mnachoka rakaraka. Nyinyi mnachoka rakaraka, sasa sijui kwa nini. Ningetaka tuangalie the concept of subsequent events, and this will not take me more than 10 minutes. Subsequent events, because already you know them. You already know them. You already know what subsequent events are. So if you allow me, I would want to clear this 105. Subsequent events after the reporting date, quite small, nothing really. Usitoke jameni. Event after the reporting date. Now we are going to look at the effects of events which occur after the end of the reporting period, but before the financial statements have been approved. These events fall into 2 types. An adjusting event, as its name might suggest, means that the accounts have to be adjusted in the light of what has happened. The rule is that adjustments must be made if the event provides evidence of conditions that existed at the end of the reporting date. An example would be a major customer going into liquidation, let's say at the end of January. The year end was end of December. That event tells us that the receivable at the end of December was probably bad, and they should have been written off or an allowance made. It's very unlikely that the customer's financial position worsened so remarkably during January. What the liquidation tells us is that the customer was in the bad situation at the end of December, and if only we had known that then the receivable would have been written down. I want to explain this a little. I wasn't sharing, I wasn't sharing. Sorry. I hope now you are able to see my screen. I hope now you are able to see my screen. Are you able to see my screen? Subsequent events. Are you able to see my screen now? Thank you very much. Great. So when you talk of subsequent means what? After. And they've told us that these subsequent events are classified into two. We have adjusting event and then we have non-adjusting events. Adjusting event, as the name might suggest, means that the accounts have to be adjusted in light of what happened. The rule is that adjustments must be made if the event provides evidence of conditions that existed at the end of the reporting period. And they've given us an example of a customer becomes bankrupt in January. Ladies and gentlemen, listen and listen to me very well. Listen and listen to me very well. When you look at this particular example, here we are in not January, but December 2021. December 2021 is with us. The management have finished doing their financial statements on 31st of December 2021. They're finished. Now they have handed them over to who? To the auditor. Now the auditor is doing his work like this. So January 2022, we have one of our key customers becoming bankrupt. And the auditor is able to see that. Perhaps it is in the news. The auditor has seen that somebody who owes us 100 million has become bankrupt. So what do you think of the receivable figure that we had on 31st December 2021, the receivable figure? Should we go to the receivables figure of 31st December 2021 and subtract 100 million from it? In short, should we adjust our financial statements? Pata potea. Hawajaelewa hiyo bado. Hawajaelewa hiyo bado. Adjust, ladies and gentlemen. Why? Because bankruptcy is a process. This guy amekuja kuwa bankrupt hapa in January, a few days after financial statements have been issued by the management. Hakukuwa bankrupt in January pap. Bankruptcy ilikuwa ilianza kitambo. Inawezekana kwamba huu jamaa alianza bankruptcy mapema, only that hatukuwa tumejua. So kumaanisha kwamba lazima tuende retrospective and then we do what here, we adjust the financial statements. So that becomes what here, an event that is adjusting. What if, ladies and gentlemen, this is 31st December 2021. Our property, plant, and equipment are worth 100 million. Immediately after we have written down our financial statements, on the 10th of January 2022, just 10 days later, we have our administration block burning down. What do you think should we do to the property, plant, and equipment? Assuming that admin block was the only PP we had, should we go back and adjust and say zero? Should we go back and adjust and say zero? Mira nasema yes. We're going to say no. No, we cannot adjust because you see, on 31st December 2021, that block, that building was in existence. So maybe ukisema to adjust, hapana, your building ilikuwa. Right? Ilikuwa. This is what you're non-adjusting. But remember, non-adjusting events must be adequately done what you disclosed in the notes of the accounts. So ukisikia kitu ya fire, right? Lakini ukisikia kitu kama tizui, yes, great. Ukisikia kitu kama ya debtors, ama court case wamelose, hiyo lazima urudi nyuma sababu court case ilikuwa tu ni kungojea judge asema, otherwise ilikuwa isha pita. That condition existed before. So a good example is the company's factory burning down. An unadjusting event relates to conditions which arose after the reporting date. A good example is the company's factory burning down. Let's say in mid-January. At the end of December, the company's factory was perfectly fine. It was standing. It was operating. It was a non-current asset. It was only after the end of the year that it was destroyed. If the statement of financial position is telling us that the position at the end of the year, then the factory would have to appear in non-current assets. It would be, of course, important to disclose in the notes that the factory was no more. This will be a good example of an emphasis of matter paragraph in the auditor's report, And that now marks the end of my today's lesson. I promised you a great lesson, and I hope it has been great. Practical things that will make us, in this case here,